Hi, this is Salman, the Director of Capital Investments. How are you all? Well, you all must have read about how you can buy ATM call option and sell ATM put option and create a synthetic futures. The payoff for this strategy or the PNL would be same as that you have for a normal future. But is this the correct way to use the options? Synthetic futures, doing it this way is like using one gear of your 5 gear car. Well, options have so much power, and if you use the options in this way, then you are underutilizing the potential of options. Well, you always know the famous quote, if you trade in futures, you have no future. But if you trade in options, then you have plenty of options. In this video, I will show you the correct way to deploy synthetic futures and also the ways to adjust it. So please do watch this video till the end because I will show you the complete synthetic futures management for maximum profitability. Now before moving on to my screen, if you are new to this channel and if you are an FNO trader or want to learn FNO trading and you want to generate significant income through futures and options, then you need to subscribe to my channel and hit the bell icon. You must have seen many videos of synthetic futures on internet, but trust me, this video is going to be more helpful than any of those videos you have seen in the past. So first let's start with the normal futures. So we'll choose the futures and expiration of 30th September, and with this expiration we will show you the strategy. So I will just show you the buy side of the strategy. You can similarly deploy the sell side of the strategy. Futures is currently running at 17,364, and here you can see the Nifty futures. The probability of profit is 50%, and the break even is exactly where you bought the futures, and the estimated margin or premium according to Opstra it is approximately 1 lakh, and you can see the Greeks, the delta is 100. At 18,000 your PNL would be 31,885. So this is the PNL on expiry or even in between. Whenever the markets reach 18,000 you will gain 31,000. So this is about normal PNL. So this is the brokerage calculator of Zerodha. So we'll just show you the Zerodha brokerage calculator. So only the brokerage part will be different with different brokers, but your STT, stamp duty and everything else will be the same. So Nifty futures at 17,365 you bought. 17,365. Okay, for this example we will take the same value. Suppose you square it off the same value. You just want to check the charges, and here you can see almost you are paying minus 194. So you're buying and selling at the same price. Now we will deploy the traditional synthetic futures. So here you could see that the Nifty is around 17,369. So 17,400 we can take it. So 17,400. Or let's take the extremely traditional one. So 17,350 is at the money. So we can buy CE, and similarly we can sell PE, and this is your traditional synthetic future, as simple as that. And here you can see the Greeks delta is again 100, and this will give you the same payoff chart. And here at 18,000 you can check it is giving T plus 0 PNL as 33,000. So that is okay. So in options there may be some price illiquidity or something like that, and we are on the weekend, so there may be some illiquidity, but almost 1 or 2,000 here and there is okay. And the estimated margin or premium is 98,000. Yes, in options there will be slightly less margin and premium. Let's just take this average of this value 190. So you suppose bought at 190, you squared it off at 190, and the quantity here is definitely 100 because you have two lots. So let's do the 100. And here you can see the net PNL at break even, it is at 81.58. So you are paying very less charges. Now for one lot you would see that okay, it's nothing, just do it for 10 lots and see there is 1,500 charges. Suppose you're doing 10 lots every month, so in a year there will be a huge difference. So that is the reason people prefer options. So this was all about the synthetic futures traditional. What I will show you is the risk defined synthetic futures. Yes, so now it's time for the big unveil. You have seen this, the actual future, how this looks like. You have seen how people teach the synthetic futures the traditional way. This is how it is. Now I will show you the correct way to do a risk defined synthetic futures. Now if you just log into Sensible and check your Nifty 30th September option chain, here just go ahead and check your target, and this is your target theta, and we'll do it with the call strategy. And here the because we are doing the buying, we are going long, hence we'll choose the calls. Here 18,000 call, just check the theta is minus 2.1. So go down and choose a similar theta call option in the money call option. So here it is 16,450. So the theta decay is 2.1. So we can just choose a lower theta decay so that we also get a 0.1 theta decay benefit. So 16,400 has a lower theta decay. So we will choose 16,400. So we cannot choose 16,450 as these strike prices are quite illiquid. So we'll choose a more liquid strike price, and that is 16,400, or you can choose 16,500 and give a 0.1 theta decay. So that's fine. So we'll just take 16,400 here. So go ahead and buy the 16,400 CE here, add, and then go ahead and sell the 18,000 CE. Here it is. Now you can see this is a risk defined futures. So this will give you profit as good as the futures, but at the same time you have the max loss predefined, and you already know by September month it will only travel till 18,000 max, because you know what, to take the market up you require money, but to push the market down you don't require any new additional capital or additional money. You just have to sell whatever you have. Here you can see the delta is almost 800, that is 84.97. I will show you the benefit of this. The premium that is you are paying is just 17,369, and hence your max profit is again the 32,000, but here the percentage is 186.26. So let's just sell a call in here to check the max profit percentage probability. Let's just sell a call at all the places. At 18,000 in the futures, we just sell a call. 1800. Here I sell this call, and anyways you will do this call selling because of the lower margin you'll have to pay for the call selling. The naked call, if you sell here, you'll have to pay a lower margin as you already have a longs future. So here you can see your max profit is again 32,000 at 18,000 CE, and your profit is 26% because you are using your estimated margin of 125. So here again in synthetic futures I have sold the CE, and you can see again 107 is the margin or premium, that is 1 lakh plus, and your probability of profit is only again 52%, and your max profit is 33,000 at 30%. And here your max profit is again at 32,000, but it is 186%. So here you can see the difference. So this is how the main synthetic future should be plotted with the defined risk. I will just show you the actual position where I have taken this trade. So I have myself went bullish on Nifty, and this is the trade I took at 16,300 C. My theta was matching with the 18,000 C, and hence I took this trade. So in this way you avoid the theta decay as well as your risk is defined. So here you can see the PNL and everything. Here you can see the Greek as well. So theta is almost only 75, so this is almost nothing, but still you will be getting this theta. And here is a payoff chart, and the max loss that you can get is only 47,000, and the max profit is 32,000 with a 186%. So that is really amazing. With only 17,000 margin, now you can have a risk defined futures. Now let's just see if you want to define the risk over here. Below 16,400 I will not have any loss. So here if you do the same thing, you go ahead in the options and you have to buy the 16,400 PE if you want to do the same thing. So you go ahead and buy it. So this is how it looks like. So your estimated margin of premium still remains 125 because of your futures. You are using the futures over here, that is the reason. And then you have the same payoff. So here is the 48,000 loss, and here is the 31,000 profit, but this is only 25%, whereas in this it is 186%. So at a very low margin you can put the futures trade with a defined risk. Let's just check the synthetic futures. Again you will just buy at 16,400, this PE you will buy. year margin with the traditional synthetic futures, if you define the risk, it's still 61,000, and your profit potential, it's still at 52%. And hence, this is the best way to do the synthetic futures with risk defined. That is buying in the money call option and selling out of the money call option, where both the theta are same. So this strategy, there are some key points here. So in the money option, you will have to use a limit order. You will not get to put a market order. And at the same time, this strategy works for index options and not for stock options, because in the money you may not have that much liquidity. Only for liquidity issue it will not work, but in stocks like Reliance and TCS it may work. They may have liquidity even for in the money options. Stock options, you generally do not try to do synthetic futures, because anyways, even this at the money put and call option will go in the money, and then again you will face liquidity issues. So we restrict the synthetic future strategy for index options only. And as you can see, for options, because the buy and sell value is small, hence the net PNL is always lesser negative even if you break even the same price. Whereas in futures, you'll have to pay more STT and everything, transaction charges, and hence you will have more points to the break even. So here it is C 3.03 points to break even, whereas in here it is only 0.3. Hence, options are preferred for synthetic futures, and we will get more and more liquidity in the money options when more and more people have this knowledge. Mainly people do futures because they do not want to square off two contracts, so they just want one contract and don't want to look at both of these. So you can see here, so in tracking futures you'll have to track both of these. So some people don't feel like I want to track two things, and they just then go ahead and buy nifty futures. Although if we spread this knowledge, you share this video with maximum friends and spread their knowledge, then hence many people will do the synthetic futures in a risk defined way at a very low margin, and that will give us more liquidity for in the money call options and in the money put options. Now with this is very easy to adjust. So if suppose market falls down, what you need to do, you just go ahead and directly start selling call options from here. So at 17,500, go ahead and start selling call options. So if the market is not going up and it's going down from here, so this is very simple, you just add this, and here you see the break even, you have already reached 17,228. Now what happens after going down? If the markets turn back, then what you do, you directly just go ahead and buy 18,200. Simple as that. Here, just look at it. Now what happens, even if it turns back and goes anywhere, you are still safe. So mind you, this will actually hamper your initial profitability and everything, but at the same time, you only did this because your view went wrong. Your view went wrong, and yet because of options, you have plenty of options, and hence you could even save the trade. So this is saving the trade after your view went wrong. So your view is bullish. If it's going down, coming back, going down, coming back. So you have plenty of options to manage it. Sell, buy, and then you can just manage it. If it's going too much down, then you can go ahead and even buy another put option here. See, just show you 16,500. We just say 16,500. So if the market falls drastically, I just bought a far out of the money option at 22.9 and just see how it went. So this is the beauty of option selling. Here you can try many iterations of adjustments. You can buy, you can sell, and do lots of iterations, and you'll figure out the best way to manage this. So you can keep on reducing your break even downwards and downwards and downwards by selling this call options multiple lots and bringing this closer, and even if it falls, it will come down around here, and then at suddenly when the markets, one day there will be a gap down and suddenly market shoot up, and then you will get a good point to exit. So this is way you can manage the futures. But if in case you do this, then already you are at 1,25,000 margin, and hence after managing this you will get further and further margin. Now if you sell a call over here, just see what happens. So if you sell a call at 17,500, if your futures goes down, then just see the margin goes 143. And here again, after doing so many adjustments, you did this, you sold another call, you bought another call, then you bought another put, and then your margin is only 34,000. So in this way your margin requirement is very less, and the synthetic future margin was already 61,000, and you have not even reached, by doing this you have not even reached the traditional synthetic future margin. And don't even talk about the traditional future. So this is the benefit of following my strategy, my way of synthetic futures. So guys, in case you have any doubts, queries or questions, do mention in the comments below. We can adjust this in the simulator in any market scenario. So you can mention in the comments below in what kind of scenarios do you want me to take, what kind of views, and adjust it. So we can always try this in option simulator, and I will show you each and every adjustment. So I have this option simulator. In case you do not have a paid account, you can let me know. Adjust the synthetic futures in any kind of market scenario and come out profitability or with a minimum loss. So do let me know in the comments below at what period of Nifty do you want me to adjust. From here you can choose any month for Nifty, and you can take any view of synthetic futures and let me know how you can adjust it, and we'll try to adjust it within 1.5 lakhs and come out profitably. I'll just give you a surprising fact that Dow Jones is falling down because of the corona fear. Although our SGX Nifty did not fall down because this coronavirus is not so much prominent in Asian markets. But if Dow Jones feels the pressure, then definitely we have FIIs who will start selling over here to save their market over there. So yes, Monday would be highly surprising, and as many people have closed the trades because it was a 3-day holiday, many traders will take the positions on Monday, and hence the market should be quite volatile. So it will be a fun journey and a roller coaster ride in Nifty the next week. So more about that we'll talk in our post market analysis that we post daily. So please do check it out and visit our channel daily for the same. So this was all about synthetic futures and options trading. So if you like the video, do hit the like button and share it with your friends. If you dislike the video, then do hit the dislike button. Just do it twice to be doubly sure. If you find this content knowledgeable, do share it with your friends and family as well. If you want me to explain about some specific strategy, or if you have doubts and queries in this strategy or any other techniques in options trading, do let me know in the comments below. I will definitely respond to all of your comments and queries. Thank you so much for watching. See you in next video. Until then, adios. My name is Salman Sheikh. Capital Investments is the name of my company. If you're new to this channel, then please do visit my channel and watch the videos. I have created very good videos for you. If you're a basic options trader and you're learning options trading, do check out my initial 4 videos. And in case you are advanced and have been following me regularly, please do check out my daily stock options trade and daily analysis of post market report.